Hello and welcome. My name is Alex Romero from Galassa Learning Solutions. And on today's Nano, we're going to be looking at the Section 529 plans, and more specifically, the independence issues and concerns in this area. So our Section 529 plans was issued on February 26, 2025. And this was in response to the consultation paper from the AICPA's PEAK, so our Professional Ethics Executive Committee, their 2021 to 2023 Strategy and Work Plan. So commenters were really looking at this as being the account owners in the 529 plans, but not always knowing the underlying investments in these 529 plans. And so this makes it a little difficult to be able to monitor and really assess if there's any independence issues when they're out there doing any of their test engagements. So let's go back and see kind of where this started. So in 2005, PEAK had developed guidance for their Section 529 plans. And under the 2005 interpretation, a covered member who owned a 529 savings plan was considered to have that direct financial interest, not only in the plan itself, but also in those underlying investments. So that conclusion was based on two factors there. It first was that the account owner selected the plan sponsor, and they had access to the details about the investment within the portfolio before making a choice. And so when you first started out and you first got your Section 529 plan and you created it, you were able to look at all the different options and you'd say, yes, I want to go with option A, and you were able to see all the different investments that were within that one plan. So at that time, this level of access and discretion was viewed as sufficient to constitute having that direct ownership of those underlying assets and those underlying investments, which is then going to directly impact your independence evaluation. So what is a direct financial interest? Well, it exists when an individual or an entity has ownership, they have control, or a beneficial interest in an investment. And this is either going to be directly or through an intermediary. So this definition includes assets that are managed by others on a discretionary basis, or interests that are held through vehicles like trusts or estates. So if an individual can supervise or influence the investment decisions, they would be considered having this direct financial interest. So this foundational concept really looked at the earlier conclusions in the 529 plan owners and saying that they do in fact have that direct financial ownership, and they do have that direct interest in these underlying investments due to their decision-making ability at the time of the selection for which portfolio they are going to be utilizing. So currently, account owners of 529 plans can still choose from a range of different portfolio options and are typically informed about those underlying investments at the time of selection. And in some cases, they may also receive some updates if those investments do change over time. But this is something that is not always going to be the case. And so we have scenarios where somebody has this account and there is a change in it, and they're unaware that there has been a change in the underlying investment. And under the old scenario, they would be considered to have that direct financial interest, which would be impacting their independence. So what's going on here is that we have a revised interpretation that really is now going to shift how the ownership of 529 plans is understood. So rather than owning the individual securities within the portfolio, so under those underlying investments, the account owner is going to hold a unit of participation in the trust. So they're going to have the entire thing and they're just going to own one unit. So they're not going to own all the different investments that make up the entire portfolio. So the account owner, they don't have authority to select or manage the underlying investments themselves. And this distinction is critical. So by removing their discretion over the specific holdings, the account owner's connection to the investment becomes indirect. And that reclassification is really going to be meaningful when we're assessing our independence. And this makes sense. So if we are able to choose what plan we want to do initially, if we have one that adjusts every year so that if you buy it when your child's an infant and they're going to use it when they graduate high school, so at the beginning it's a little bit riskier, and then every year it adjusts so that it becomes a more conservative investment at the end, but you never find out what those changes are. It's unrealistic to think that you have a direct financial interest because you don't have any authority. You didn't say, yes, please go ahead and adjust this and make sure that we're investing in this area. A lot of this is automatic, and as we pointed out here, you might not even get notification that this has happened. So further supporting this revised view, the plan manager and not the account owner is the one that has the sole authority to really modify the underlying investment offerings that are within this 529 plan. Also, we have the Internal Revenue Code. It really restricts how often an account owner can reallocate these assets. So you're limited to just 2 changes per beneficiary per calendar year. So these constraints reinforce the conclusion that the account owner really lacks control or influence over these specific investments. And distinguishing this from having that direct ownership scenario, this again shifts us from being in a direct area to having that indirect. So based on the revised understanding, the AICPA now considers that if a CPA is an account owner in a 529 plan, so they are one of the account owners, and the plan itself is going to be the ad-test client. So if you have an account through Morgan Stanley and you are doing ad-test work for Morgan Stanley, your influence would be impaired. Right? That makes sense. That if we are going to be doing ad-test work and we are at the location that is the plan sponsor and we are invested in there, that yes, we are directly going to have an independence issue there. And this is going to apply to both our prepaid tuition plans and those savings plans. So the account owner's interest is now going to be classified as being indirect financial interest because they only own a unit in the pooled investment, not the underlying securities themselves. So while this kind of reduces the independence concerns and the independence threats here, it doesn't eliminate it entirely. So we still need to make sure that we are looking at the plan, and if we are able to see some of these underlying investments, that we are still having that consideration in assessing if there is going to be any independence issues for our ad test engagements. So if we do have an investment that is going to be considered material to the covered member, we might have an independence issues. So in such cases, the self-interest threat rises above an acceptable level, and the AICPA is going to outline 3 different safeguards that you can apply if you are in this situation. So the first thing you could do is you could reallocate those holdings to eliminate that material interest. You can transfer the account to a different 529 plan without conflict, or you can transfer the ownership to someone that's not subject to the independence rules. But you have to think about this and really do this as soon as you find out that there needs to be another safeguard that's applied. It needs to be no later than 30 days. The only exception here is if that's going to have a tax implication. And if that's the case, if you're not able to apply one of these safeguards, then that individual just needs to not be on the ad test engagement team or not have any influence over that ad test engagement. Now, when we're looking at beneficiaries, they are going to be not considered to have a financial interest if they are only receiving distributions from the account. So that is, again, something that makes sense, so that if you are just a beneficiary to this plan, then you're not going to be the one that is really having that direct ownership and that direct interest in there. You are just the one that is going to be receiving the funds out of that to maybe pay for your qualified higher education expenses, and that you aren't going to be actually the authorized account owner. So this is an area that got a little bit more clarification so that it's a little bit easier to really identify when you do have an independence issue here. So this is going to be effective for May 31st, 2025. So thank you very much for joining me today as we looked at the Section 529 plans and about the independence issues and our direct or indirect interest in those plans. Thank you.